Hello there. Today we will learn how to mind map IAS 36. Impairment of Assets. Before going further, we need to understand IAS 36. Impairment of Assets. IAS 36 seeks to ensure that an entity's assets are not carried at more than their recoverable amount. Impairment means that asset has suffered a permanent loss in value. An asset is said to be impaired when its recoverable amount is less than its carrying amount. IAS 36 does not apply. IAS 36 applies to all assets except followings: inventories, revenue from contract, deferred tax asset, assets from employee benefit, financial asset, consolidated financial assets, investment property measured at fair value. Whereas IAS 36 does apply to all assets including financial assets classified as subsidiaries, associates, joint ventures. Indicators of impairment. Indicators may be external factors or internal. External factors includes unexpected decline in market value, significant changes in technology, market, laws and recognition, increase in interest rate, affecting value in use of asset. Whereas internal factors includes evidence that the asset is damaged or no longer of use to the entity. There are plans to discontinue or restructure the operation for which the asset is used. There is a reduction in the asset's expected remaining useful life. Recoverable amount of an asset. It is the higher of fair value, or its value in use. Fair value. Fair value is normally market value at measurement date. If no active market exists, it may be possible to estimate the amount that the entity obtained from the disposal, less direct selling costs. Redundancy costs are not direct selling costs. Value in use. It's the present value of the expected future cash flows from the use of the asset discounted at a suitable discount rate or cost of capital. And includes cash inflows from the use of asset. Cash outflow necessary to generate cash inflow. Net disposal proceeds at the end of the asset. It does not include cash inflows, outflows from financing activities, income tax receipts or payments. Accounting for impairment. An entity must carry out an impairment review when there is evidence, or an indication that impairment may have occurred. If such an indication exists, the entity must estimate the recoverable amount of the asset, so that to compare it with carrying amount of the asset for any impairment loss. The impairment loss is normally recognized immediately in profit or loss. However, if there is a revaluation surplus in respect of an asset, an impairment loss is recognized in respect of that asset to the extent covered by that surplus. Thus, it is treated in the same way as a downward revaluation. The part of impairment not covered by surplus is recognized in profit or loss. Following the recognition of impairment, the future depreciation must be based on the revised carrying amount, minus residual value, over the remaining useful life. Cash generating unit. A cash generating unit, CGU, is the smallest identifiable group of assets that generate cash inflows that are largely independent of the cash inflows from other assets or groups of assets. Allocating impairment loss to assets of CGU. When an impairment loss arises on a cash-generating unit, the impairment loss is allocated across the assets of the cash-generating unit in following order. First, to the goodwill, then to other asset in CGU on a pro rata basis, that is proportion to carrying amount of the asset of the CGU. However, the carrying amount of an asset cannot be reduced below highest of fair value, less cost of disposal, value in use, and 0. Thanks for watching. More stuff coming soon.